Economic ramifications for the shipping industry. Projected 15% increase in shipping insurance premiums by Q1 2025. Introduction. The shipping industry, a vital component of global trade, is set to experience significant economic ramifications due to a projected 15% increase in shipping insurance premiums by the first quarter of 2025. This increase is primarily driven by heightened military presence in key maritime regions, reflecting rising geopolitical tensions, piracy threats, and the potential for conflict. As insurance costs rise, the implications for shipping companies, global trade, and consumers are profound and multifaceted. Background. The shipping industry has faced numerous challenges in recent years, including supply chain disruptions due to the COVID-19 pandemic, international trade disputes, and now escalating military activity in critical shipping lanes. The industry is characterized by its sensitivity to geopolitical events, which can dramatically alter risk assessments and operational costs. Geopolitical tensions. Geopolitical tensions have been escalating, particularly in regions such as the South China Sea and the Gulf of Aden. The presence of military forces in these areas, while intended to deter piracy and ensure maritime security, has also raised concerns about potential conflicts. Shipping companies are increasingly reassessing their risk management strategies in light of these developments. Reports indicate that the heightened military presence serves as both a deterrent to piracy and a catalyst for conflict, with insurance underwriters adjusting their risk profiles accordingly. Cost implications. The anticipated increase in shipping insurance premiums will impose a significant economic burden on shipping companies. Higher insurance costs will likely lead to increased freight rates, which could be passed on to consumers. This scenario not only affects individual businesses but has broader implications for global trade prices and may contribute to inflationary pressures. Integration of information. The projected 15% increase in shipping insurance premiums reflects a convergence of various factors affecting the maritime industry. Reports from multiple sources indicate that the shipping industry is grappling with rising costs due to the combined effects of geopolitical tensions, piracy threats, and ongoing supply chain disruptions. Supply chain disruptions. The COVID-19 pandemic introduced unprecedented volatility in shipping costs, resulting in supply chain disruptions that are still being felt. These disruptions have forced shipping companies to adapt quickly, often at increased costs. Analysts suggest that the combination of pandemic-related issues and rising geopolitical tensions has created a perfect storm for the shipping industry, resulting in increased operational costs, including insurance. Market adjustments. In response to the anticipated rise in insurance premiums, shipping companies are expected to implement various market adjustments. Key strategies may include: 1. Enhanced security measures. Shipping companies may invest in improved security protocols to mitigate risks associated with piracy and geopolitical tensions. This could involve hiring private security firms or enhancing onboard security for vessels operating in high-risk areas. 2. Diversification of routes. To avoid high-risk areas, shipping companies may restructure their operational routes. This could lead to longer transit times and increased costs, but may be necessary to ensure the safety of cargo and crew. 3. Risk mitigation strategies. Companies may also seek to develop comprehensive risk mitigation strategies that include better risk assessment models and insurance coverage options tailored to the current geopolitical climate. Economic impact on global trade. The increase in shipping insurance premiums and the associated cost implications will likely have ripple effects throughout the global economy. Some of the potential impacts include: 1. Increased freight rates. As shipping companies pass on the increased costs of insurance to consumers, freight rates are expected to rise. This will impact the price of goods globally, leading to higher costs for consumers. 2. Inflationary pressures. The rise in shipping costs may contribute to inflationary pressures in various economies, particularly those heavily reliant on imports. As the cost of goods increases, consumers may face tighter budgets, leading to reduced spending in other areas. 3. Supply chain restructuring. The anticipated increase in premiums may encourage companies to rethink their supply chain strategies. Businesses may seek to source materials closer to home or invest in alternative transportation methods to mitigate rising shipping costs. Long-term outlook. While the projected increase in shipping insurance premiums is expected to take effect by Q1 2025, the long-term outlook for the shipping industry remains uncertain. Analysts have differing views on how these changes will shape the industry's future. 1. Stabilization of the industry. Some analysts believe that the shipping industry may stabilize as companies adapt to increased costs and risks. They argue that shipping companies will find ways to innovate and implement cost-saving measures, ultimately leading to a more resilient industry. 2. Sustained high premiums. Conversely, other analysts express concern that ongoing geopolitical instability could lead to sustained high insurance premiums. If tensions continue to escalate, shipping companies may face prolonged economic challenges, resulting in a more significant impact on global trade dynamics. Timeline of events. 2020 to 2021, the COVID-19 pandemic disrupts global supply chains, introducing volatility in shipping costs. 2022, heightened geopolitical tensions emerge, particularly related to Russia's actions in Eastern Europe and China's assertiveness in the South China Sea. 2023, increased military presence in strategic maritime areas is noted, leading to discussions regarding implications for shipping insurance. 2024, insurance companies adjust their risk models in anticipation of rising premiums, prompting shipping companies to reassess operational strategies. Q1 2025, the anticipated 15% increase in shipping insurance premiums is implemented, with widespread implications for shipping costs and global trade dynamics. Conclusion. The projected 15% increase in shipping insurance premiums by Q1 2025 underscores the interconnectedness of global trade and security considerations. As geopolitical tensions rise and military presence in maritime regions heightens, the shipping industry must navigate significant changes in cost structures and operational strategies. The economic ramifications will extend beyond the shipping sector, affecting consumers and global trade dynamics. While the industry may eventually stabilize, the path forward is fraught with uncertainty, and stakeholders must remain vigilant in adapting to these evolving challenges. The projected 15% increase in shipping insurance premiums by Q1 2025 presents several counterintuitive insights regarding the economic ramifications for the shipping industry. Here are key points that challenge conventional wisdom and highlight unexpected implications. 1. Increased military presence doesn't always equate to greater security. While one might assume that a heightened military presence in maritime regions would lead to improved safety for shipping operations, the reality is more complex. The presence of military forces can escalate tensions and increase the probability of conflict, which can paradoxically enhance perceived risks rather than mitigate them. This could lead insurers to classify these areas as higher risk zones, thus driving up insurance premiums. 2. Risk mitigation strategies may not offset cost increases. Shipping companies are likely to invest in enhanced security measures and diversify routes to mitigate risks associated with higher premiums. However, these strategies could incur substantial costs that may not fully offset the increased insurance expenses. This could lead to a scenario where companies are spending more on risk management while still facing higher operational costs, creating a double burden. 3. Impact on consumer prices could be overlooked. The assumption that increased shipping costs will be absorbed by shipping companies might ignore the reality that these costs are generally passed down the supply chain. As shipping firms raise freight rates to compensate for higher insurance premiums, the ultimate effect could be a rise in consumer prices, contributing to inflation. This outcome may be unintuitive, as it suggests that the shipping industry's challenges could have a broader economic impact beyond just the sector itself. 4. Potential for market consolidation. Increased insurance premiums and associated costs might lead to a consolidation in the shipping industry. Contrary to expectations that competition would thrive in a recovering market, smaller firms may struggle to absorb the increased costs, leading to a scenario where market consolidation occurs. This could reduce competition in the long term and potentially lead to higher prices for consumers. 5. Geopolitical risks could drive innovation. While heightened military presence and geopolitical tensions are generally seen as negative factors for the shipping industry, they could also spur innovation in logistics and transportation solutions. Companies may seek to develop new technologies or methodologies that enhance efficiency and safety, which could lead to unexpected advancements in how shipping is conducted. This counterintuitive outcome suggests that adversity can sometimes foster creativity and improvement. 6. Long-term insurer strategies might differ. Some analysts suggest that while premiums will rise in the short term, insurers might adapt their models over time to stabilize prices as the shipping industry adjusts. This notion challenges the idea that high premiums will persist indefinitely, indicating that the market dynamics could shift in response to the adaptations made by both insurers and shipping companies. 7. Regional disparities in impact. The projected increase in insurance premiums may not affect all shipping routes equally. Areas with lower geopolitical risks might see less dramatic increases or even stability in premiums, creating a competitive advantage for shipping companies operating in those regions. This regional disparity could lead to unexpected shifts in trade routes and partnerships as firms seek to minimize costs, which may not align with traditional expectations of uniform cost increases across the industry. 8. Insurance as a catalyst for operational changes. Increased insurance costs could drive shipping companies to re-evaluate their operational practices, potentially leading to more sustainable practices or investments in greener technologies. While higher costs are typically viewed as a negative, they could also serve as a catalyst for necessary changes within the industry that align with global sustainability goals, presenting an unexpected opportunity for positive transformation. In conclusion, the anticipated 15% increase in shipping insurance premiums driven by heightened military presence carries several counterintuitive implications for the shipping industry. From the relationship between military presence and security to the broader economic impacts on consumer prices and potential market consolidation. These insights challenge conventional thinking and highlight the complexities of the shipping industry's response to geopolitical tensions and operational challenges. The report on the projected 15% increase in shipping insurance premiums by Q1 2025 due to heightened military presence in key maritime regions encompasses several critical elements that may be overlooked by many stakeholders in the shipping industry. Here are the significant aspects and their implications. 1. Underestimated impact on smaller shipping companies. While larger shipping companies typically have more resources to absorb increased costs and adapt their strategies, smaller companies may struggle significantly. The report suggests that the economic burden of higher insurance premiums could be disproportionately felt by these smaller firms, which often operate on thinner margins. This could lead to increased consolidation in the industry, as smaller companies may be forced out of business or driven to merge with larger entities to survive. The long-term implications of reduced competition could stifle innovation and lead to higher prices for consumers. 2. Disruption to supply chain resilience. The anticipated rise in shipping insurance premiums may lead companies to alter their supply chain strategies, potentially prioritizing cost-cutting measures over resilience. For example, firms might choose to take longer, less costly routes to avoid high-risk areas, which could increase delivery times and disrupt the just-in-time inventory systems that many companies rely on. This shift may not only affect individual companies but could also have cascading effects on global supply chains, leading to shortages and increased prices for consumers. 3. Geopolitical risk assessment. The report highlights the correlation between military presence and perceived threats to maritime security, which is significant for risk assessment. However, it may be overlooked that the geopolitical landscape is fluid. The shipping industry must remain agile and continuously reassess its risk management strategies in response to evolving geopolitical situations. The ability to predict and react to potential conflicts or changes in military presence can be a competitive differentiator in the market. 4. Potential for increased piracy and insurance claims. With military forces deployed in high-risk maritime areas, there is a dual effect. While military presence can deter piracy, it can also escalate tensions that may lead to increased piracy in less secure regions. An overlooked aspect is the potential for increased insurance claims from piracy-related incidents, which could exacerbate the rise in premiums. Shipping companies may need to invest more in security measures, which can further inflate operational costs and impact overall profitability. 5. Inflationary pressures beyond freight rates. The report emphasizes how higher premiums could lead to increased freight rates, impacting consumers and potentially causing inflationary pressures. However, the significance of this inflation may extend beyond shipping costs. As companies pass on these costs to consumers, we could see a broader economic impact as prices rise across various sectors. The interaction between shipping costs and consumer prices may not be fully appreciated by policymakers, who could underestimate the compound effects on the economy. 6. Environmental considerations and sustainability. As shipping companies adapt to increased costs and changing operational dynamics, there is a risk that environmental sustainability initiatives might be sidelined. The focus on cost management could lead companies to prioritize short-term financial stability over long-term sustainable practices. This could hinder progress toward reducing carbon emissions and improving environmental standards in the shipping industry, which is already under scrutiny for its environmental impact. 7. Insurance market dynamics. The report mentions that insurance companies will adjust their risk models in anticipation of rising premiums, but the broader implications of these market dynamics may be overlooked. Increased premiums may lead to a tightening of the insurance market, making it more difficult for companies to obtain coverage. Additionally, this could encourage the development of alternative risk financing mechanisms such as captives or self-insurance, which could fundamentally alter the insurance landscape for the shipping industry. 8. Long-term implications of military presence. While the immediate focus is on the projected increase in premiums, the long-term implications of heightened military presence in maritime regions need attention. The potential for ongoing or escalated military conflicts could lead to sustained high premiums, altering the competitive landscape of the shipping industry. Stakeholders may need to consider the strategic implications of military presence in their long-term planning and risk management strategies. 9. Shift in global trade dynamics. The interconnectedness of global trade means that changes in the shipping industry's cost structure can have ripple effects across various economies. Countries heavily reliant on maritime trade may face economic challenges as shipping costs rise, potentially leading to shifts in trade patterns. This could also affect political relationships and economic policies as nations re-evaluate their trade dependencies and seek to mitigate vulnerabilities. 10. Consumer awareness and response. Consumers may not fully grasp how changes in shipping insurance premiums and subsequent freight rate increases will affect the prices of goods they purchase. Increased consumer awareness of the shipping industry's challenges, including the costs associated with military presence and piracy, could lead to public pressure for more transparency in pricing and logistics practices. Retailers and manufacturers may need to communicate these challenges more effectively to maintain consumer trust and loyalty. Conclusion. In summary, while the projected increase in shipping insurance premiums due to heightened military presence is significant, the far-reaching economic ramifications extend beyond mere cost increases. Stakeholders must consider the implications on smaller shipping companies' supply chain resilience, geopolitical risk assessments, piracy incidents, inflationary pressures, environmental sustainability, insurance market dynamics, and the broader shift in global trade. Understanding these nuances is critical for navigating the complexities of the shipping industry in a changing geopolitical landscape. Addressing these overlooked aspects can help companies and policymakers develop more robust strategies to mitigate risks and capitalize on opportunities in the face of rising uncertainties. 1. Geopolitical tensions and risk assessment. The first key point revolves around how geopolitical tensions, particularly in critical maritime regions like the South China Sea and the Gulf of Aden, are reshaping risk assessments in the shipping industry. The increased military presence acts as a double-edged sword. While it may deter piracy, it also raises the potential for conflict, making insurers more cautious. This heightened risk perception compels shipping companies to adapt their strategies, significantly influencing their operational and financial planning. 2. Economic burden of increased insurance costs. The projected 15% increase in shipping insurance premiums translates to a substantial economic burden on shipping companies. This point highlights how higher premiums can lead to increased freight rates, which shipping companies may pass on to consumers. Such a ripple effect could impact global trade prices, contributing to inflationary pressures. The analysis of these cost implications is crucial for understanding the broader economic landscape, especially as consumer prices are already under strain from other factors. 3. Adaptation strategies and market restructuring. Shipping companies are expected to implement various adaptation strategies in response to the anticipated increase in insurance costs. This includes investing in enhanced security measures and diversifying shipping routes to mitigate risk. The discussion around market adjustments is vital as it indicates a potential restructuring of shipping lanes and partnerships, which could have long-term implications for global trade patterns and logistics. For long-term implications and stability, the differing perspectives on the long-term implications of increased insurance premiums are significant. Some analysts foresee a stabilization of the shipping industry as companies adapt to new cost structures, while others warn of sustained high premiums due to ongoing geopolitical instability. This point emphasizes the uncertainty within the industry and the potential for ongoing volatility in global trade dynamics, making it a crucial area for in-depth analysis and discussion regarding future trends in shipping and international trade relationships. 1. The Suez Canal Crisis. 1956. The Suez Crisis was a diplomatic and military confrontation involving Egypt, Israel, the United Kingdom, and France, which had significant implications for international shipping. The nationalization of the Suez Canal by Egyptian President Gamal Abdel Nasser led to military intervention by the UK, France, and Israel. The crisis caused a major disruption in shipping routes, resulting in increased shipping insurance premiums and freight rates as shipping companies reassessed the risks of navigating through the canal, which was a critical trade artery. The situation highlighted how geopolitical conflicts can lead to significant economic repercussions for the shipping industry, impacting global trade. 2. The Gulf War. 1990 to 1991. The Gulf War had profound effects on maritime shipping due to the heightened military presence in the Persian Gulf. The conflict led to a substantial increase in shipping insurance premiums as the risk of attacks on vessels increased, particularly those transporting oil. Shipping companies faced increased costs and operational risks, which were passed on to consumers through higher freight rates. The war underscored the vulnerability of maritime trade to regional conflicts, demonstrating how military interventions can disrupt shipping routes and elevate insurance costs, thereby affecting global markets. 3. Piracy off the coast of Somalia. Early 2000s. The rise of piracy in the waters off Somalia during the early 2000s significantly impacted the shipping industry. The surge in piracy led to increased shipping insurance premiums as shipping companies faced higher risks when operating in the region. In response, many companies implemented enhanced security measures such as hiring private security contractors and rerouting ships to avoid high-risk areas. The piracy crisis exemplified how non-state actors alongside geopolitical tensions can lead to increased operational costs, affecting insurance rates and ultimately influencing global trade dynamics. The situation prompted international naval coalitions to increase military presence in the region to protect shipping interests. further intertwining military actions with economic ramifications for the shipping industry. The projected 15% increase in shipping insurance premiums by Q1 2025 due to heightened military presence in strategic maritime regions will have profound economic ramifications for the shipping industry and global trade. Here are the key future outlook predictions based on this scenario. 1. Increased freight rates. With shipping insurance premiums on the rise, shipping companies will likely pass these costs on to consumers in the form of higher freight rates. This increase will affect the overall cost of goods, contributing to inflationary pressures worldwide. Consumers may see price hikes in essential goods, especially those that rely heavily on maritime transport such as electronics, consumer goods, and raw materials. 2. Shift in shipping routes. To mitigate risks associated with high insurance costs and geopolitical tensions, shipping companies may alter their operational strategies. This could involve rerouting vessels away from high-risk areas, which may lead to longer transit times and increased fuel costs. As a consequence, the shipping industry may witness a restructuring of traditional shipping lanes, affecting global supply chains and logistics networks. 3. Investment in security and risk mitigation. Faced with higher risks, shipping companies are expected to invest more in security measures and risk management strategies. This could include hiring private security firms, using advanced tracking technology, and enhancing vessel security protocols. The increased expenditure on security may further escalate operational costs, reinforcing the cycle of rising prices in the shipping sector. 4. Consolidation in the shipping industry. Smaller shipping companies may struggle to absorb the increased costs associated with higher insurance premiums and security measures. As a result, the industry may see a wave of consolidation, with larger firms acquiring smaller players to enhance their market share and operational efficiency. This trend could lead to a reduction in competition and potentially higher prices for consumers in the long run. 5. Changes in insurance market dynamics. The rise in premiums may prompt a re-evaluation of insurance models within the shipping industry. Insurers could develop new products tailored to the evolving risk landscape, including specialized policies for high-risk routes. This shift may also lead to increased scrutiny and regulation of the maritime insurance market as stakeholders seek to balance risk with cost. 6. Impact on global trade patterns. As shipping costs rise, there may be significant shifts in global trade patterns. Countries that rely heavily on imports may face challenges in sourcing goods at competitive prices, potentially leading to a push for local manufacturing or alternative supply chains. This could also affect trade relationships, as nations that are less exposed to maritime risks may gain a competitive advantage. 7. Long-term geopolitical implications. The heightened military presence in maritime regions is indicative of broader geopolitical tensions. Should these tensions escalate into conflict, the shipping industry could face more severe disruptions, including blockades or attacks on vessels. In the long term, sustained instability may lead to a re-evaluation of global trade agreements and alliances, reshaping the landscape of international commerce. 8. Sustainability considerations. As the shipping industry grapples with rising costs, there may be an increased focus on sustainability. Companies might seek to invest in greener technologies to reduce fuel consumption and emissions, potentially offsetting some of the heightened costs. This could lead to innovations in shipping practices, such as the adoption of alternative fuels and more efficient vessel designs. 9. Technological advancements. The shipping industry may increasingly turn to technology to address challenges posed by rising insurance costs and geopolitical risks. Innovations in automation, artificial intelligence for route optimization, and blockchain for supply chain transparency could play crucial roles in enhancing operational efficiency and reducing costs. 10. Resilience and adaptability of the shipping sector. Ultimately, the shipping industry has historically demonstrated resilience and adaptability in the face of challenges. While the projected increase in insurance premiums and the associated geopolitical tensions present significant hurdles, the industry's ability to innovate and adjust strategies will be critical in navigating these changes. Companies that proactively manage risks and embrace new technologies are likely to emerge stronger in the evolving landscape. Conclusion: the anticipated 15% increase in shipping insurance premiums due to heightened military presence will have far-reaching economic implications, influencing freight rates, shipping routes, and global trade dynamics. As the industry adapts to these changes, stakeholders must remain vigilant and proactive in managing risks, investing in security, and leveraging technology to ensure resilience in an increasingly complex maritime environment. The interplay between geopolitical stability and the shipping industry's operational strategies will shape the future of global trade in the years to come.